Welcome to our channel. Have you ever looked at your life at age 40 and felt like you were just a cog in a massive machine, grinding away for a paycheck that barely covers the cost of being alive? Most of us are taught that the path to success is simple. Study hard, get a stable job, listen to your parents, and stay away from anything that looks like gambling. But today, we are going to dive into the story of a man who realized at 40 that this traditional path might not be the golden ticket everyone promised. We are talking about the monster old man, or Gwylaizi, a man who transformed himself from a math-obsessed engineer into a legendary figure in the world of finance. Now, before we get into the meat of his strategy, we have to talk about that nickname. Why would a wife call her husband a monster? Well, in this case, it is not because he has 3 heads or eats cold pizza for breakfast. It is because, while most men his age were taking up golf or obsessing over sports, he was literally hugging his mathematical formulas to an outsider. It looked like a strange obsession. But to an engineer, if you do not have numbers, you simply do not have a basis for making a decision. He is a man who has been in a committed relationship with Excel for nearly 40 years. He even remembers the days of Lotus 123, which was basically the dinosaur ancestor of the spreadsheets we use today, back before Windows was even a thing. For him, Excel is not just software, it is a tool for survival. Whether it was calculating the break-even point for a new product at his old company, or figuring out if a stock is a bargain or a trap, the spreadsheet was always the ultimate source of truth. But why did it take until he was 40 to start? If you look at the year 1997, the world was a very different place. There was no internet where you could just search for how to retire early. Information was scarce, and the publishing industry was just starting to figure out financial self-help. Growing up, he followed the standard parental advice: work hard and avoid speculation. He lived through the 1996 stock market bubble, where the market was hit by limit ups and limit downs every single day. To him, the stock market looked like a giant smoke-filled casino, and since he hated gambling, he stayed far away from it. The catalyst for change was a classic high school reunion. We have all been there. You walk in, feeling pretty good about your middle management job, and then you see the guy who used to fail every math test. Suddenly, he is the most popular person in the room, not because of his charm, but because he is fabulously wealthy. Our guest was initially annoyed, thinking it must have been pure luck. And in a way, it was. This classmate had run a gambling ring for the local lottery and then dumped all that cash into real estate just as the market exploded. By his mid-30s, that guy was worth over $100 million. This was a massive wake-up call. It forced our guest to realize that truly wealthy people do not get there by trading their time for a salary. They get there through equity, through company listings, or through smart long-term investments. But when he tried to learn how to invest, he found the mainstream advice to be completely nonsensical. He would see experts on TV drawing lines on charts, pointing at M-head patterns and support lines. To a logical engineer, this looked like trying to predict the future by reading tea leaves. He could not understand why one M shape was different from another, or why any of it should be trusted. So he did what any self-respecting nerd would do. He went to the library and grabbed the actual textbooks on investment theory. When he opened those academic pages, he found exactly what his soul was craving. It was not about drawing pictures, it was about probability, statistics, and heavy-duty mathematics. This was the scientific foundation of finance. He realized that there was a massive gap between the astrology taught in popular magazines and the rigorous science taught in universities. He combined this academic rigor with the simple wisdom of books like The Financial Bible, which taught him to buy good stocks and just never sell them, and A Random Walk Down Wall Street, which explained high-level investment theory in a way that regular humans could understand. Feeling empowered by his new knowledge, he finally dipped his toes into the market. His very first purchase was TSMC. at $52. At the time, he was so terrified that he actually called his broker to ask if he was making a fool of himself by buying at such a high price. It is funny to think about now, but at that moment, it was a huge leap of faith into the unknown. However, the universe has a way of testing new investors. By the year 2000, the dot-com bubble was at its peak. Everyone was losing their minds over the internet, even though it took an eternity just to load a single page of text. Our guest thought he had it all figured out. He was so confident in his newfound skills that he decided to go all in. He didn't just use his savings, he took out a mortgage on his home to leverage his position. He believed a neighbor who told him that every time the Taiwan stock market fell below its 10-year line, it was a guaranteed bounce-back opportunity. Then, 9/11 happened. The market didn't just dip, it went into a free fall, and it dropped from 6,000 points to 3,000 points, effectively vaporizing half of his wealth. The psychological pressure was unbearable. He couldn't sleep, and eventually he did what most people do when they are staring into the abyss. He panicked. He sold everything just to pay back the loan and survive. And as the universe would have it, the moment he sold, the market began its recovery. This was a brutal and expensive lesson, but he didn't quit. He realized that the textbooks were right all along. Never borrow money to invest, and always maintain a balance between stocks and bonds. This experience is what allowed him to stay calm during the 2008 financial crisis. While everyone else was screaming, he was fine because his bond holdings were rising as his stocks were falling, providing a natural cushion. A lot of people ask how he turned a $3 million nest egg into enough to retire in just 10 years. He is very clear about the math. You cannot do it through investment returns alone unless you are incredibly lucky. The secret sauce was his high salary as a senior manager. He was consistently pumping $40,000 to $50,000 a month into his portfolio while maintaining a steady 10% return. This is a vital lesson for everyone. Compound interest is a powerful engine, but it needs fuel. If you have $100,000, a 10% return only gets you $10,000. But if you have $5 million, that same 10% gives you $500,000 in a single year. This is why he tells young people to focus on their primary careers first. Build your capital and then let the market do the heavy lifting. He also challenges the idea that it is ever too late to start. In fact, starting at 50 or 60 can be even more effective because you likely have more savings than a 20-year-old. When you have a larger pile of cash, even a small percentage gain has a massive impact on your wealth. When it comes to strategy, he is a firm believer in using assets that have a negative correlation. This is just a fancy way of saying you should find things that move in opposite directions. Usually when the stock market is crashing, bonds are the safe haven everyone runs to. By holding both, you can rebalance. When bonds are high and stocks are low, you sell some bonds and buy the cheap stocks. This is how you buy low and sell high without having to guess the future. He advises investors to think like a bank. A bank doesn't risk all its money on one borrower. It spreads the risk across thousands of people so that if one person fails, the system stays intact. For the average investor, this means using ETFs. Instead of trying to guess which individual company will be the next superstar, just buy the entire market. He suggests broad market ETFs like the S&P 500 or total world stock market ETFs like VT. Why bet on just one country when you can own the top performing companies on the entire planet? He also has some strong opinions on the popular high dividend ETFs. While they sound great because they give you regular cash, he warns that they often leave out the most successful companies. For example, a company like TSMC might reinvest most of its profits into research and development to stay ahead of the competition, meaning its dividend yield might not be high enough for a dividend-focused fund. If you only buy high dividend stocks, you are essentially ignoring the world's most profitable growth engines. He prefers market cap weighted funds like 0050 because they automatically invest more in the companies that are actually winning the game of capitalism. His decision to retire at 50 wasn't entirely a happy one at first. He was suffering from high stress and panic disorder, and his company wasn't doing particularly well. He sat down with his wife, who was a stay-at-home mom and completely dependent on his income, and showed her his master Excel sheet. He mapped out the next 35 years of their lives. He showed her that even with a very conservative 4% return, they could live comfortably until he was 90. He even showed her a doomsday scenario where they just lived off bank interest. That data-driven proof gave her the peace of mind to support his retirement. Retirement, however, didn't mean he stopped working. He discovered he had a knack for teaching. He started at a community college, taking the complex math of finance and translating it into plain English for regular people. This grew into books, a popular website, and a YouTube channel. He often finds himself working until 2 a.m. on a new spreadsheet or video, but he doesn't feel the fatigue he felt at his old corporate job. When you are doing something you truly love, it doesn't feel like work. Interestingly, his retirement income from books and teaching eventually surpassed the high salary he had as a manager. He is also humble enough to admit he still makes mistakes. Recently, he let greed get the better of him and put 80% of his portfolio into bonds, betting on a massive price spike when interest rates dropped. As a result, he missed out on a huge stock market rally. He uses this as a lesson for his students. Human emotion is the enemy of profit. Mechanical investing, sticking to a fixed plan regardless of how you feel, is the only way to win in the long run. The mindset you need before retirement is completely different from what you need after. Before you retire, you have a salary, so you can afford to be aggressive and aim for growth. Once the salary stops, your priority shifts to stability and managing volatility. You want to make sure your pile of money lasts as long as possible while minimizing the swings that could cause you to panic. His final words of wisdom are about finding your center of gravity. Retirement shouldn't just be about escaping a job you hate. It should be about moving toward something you love. Whether it is gardening, teaching, or studying advanced statistics, you need a reason to wake up in the morning. Financial freedom is the foundation, the bottom gas, that gives you the confidence to live life on your own terms. It doesn't matter if you are 40, 50, or 60. The math doesn't care about your age. If you can stay logical, keep your expenses in check, and let the science of investing work for you, financial freedom is closer than you think. Just remember to keep your spreadsheets close and your emotions even closer. Thanks for sticking with us through this deep dive into the mind of a master investor. If you found these insights valuable, please welcome to subscribe and like